All right, we're going to get started. Thank you all for coming. I'm Kurt Zuckert. I'm part of the Market Education Department here at CME Group. CME Group Education does seminars like this on a regular basis. I encourage you all to check our website, cmegroup.com/education, for information about our upcoming seminars and programs. So if you check our Market Education calendar, you'll see what's upcoming. We have a lot of archived material on there as well, and I encourage you all to utilize that part of our website. So I'm going to get started. We'll switch the microphones. Besides saying his name, J. Peter Steidlmayer, I don't think there's any other introduction needed. Peter's going to give his program today, and hopefully everyone has a handout, and he'll answer questions at the end.
Thank you for coming, and it's really a lot of fun for me to do this because I really approached the market from more of an academic standpoint, and it was always very important for me to understand what I was doing if I was doing it wrong. And the idea is that there has to be a change coming from the pit traded markets we've all experienced and the electronic markets, which basically are a lot different from what we were used to. And we need to find a commonality between them. In other words, what is the common ground of trading in electronic markets and the pit markets? And when we find that common ground, we can begin to go forward. It's the responsibility of the exchange to provide information so that people can trade. And one of the things that's happened is that the front ends of the electronic system are not a formal exchange by themselves, but they represent an exchange where we trade. But no one's really taken the data that comes from there and basically applied it to the market. So when you do that, trading can become a lot simpler than trying to apply it where something else takes place. And I always have a big, difficult time getting people on board to what I'm doing. One of the reasons is I'm not that great at communication, and the way I see it and you see it is going to be different. But one of the problems is that there's the scope of what I'm talking about that basically scares people off. So this is a tremendous scope, what we were looking at, and one of the reasons that I became director when Les Rosenthal was chairman was that the scope of the programs that we were coming up with, he wasn't afraid of. I mean, Les was not afraid of the scope of anything, and if you had the right idea, he's going to back you. And so the last couple of years, we're working with him on an automatic trading program, and this opportunity came along. And I went to Bill Cunningham and I said, you know, why don't we do this? And so he and I are partners on this program. And it is a front-end app that goes right now on T4, and eventually we'll have it on Onyx and then on TT. But the idea is I don't want you to get intimidated by the scope of the necessary changes you're going to have to make, because we all have to make those changes. And the idea is you have to familiarize yourself with the problems that you have trading now and find new ways to solve them. So the idea is that you solve, if you're a baseball player and you can't hit the outside pitch and you learn to do it, you solve that problem. So to the degree that we solve the market, we basically allow ourselves not to make all the money in the world, but to be able to function within the marketplace. So the idea, I probably solved the market 4 or 5 different times, which made me functional. And that doesn't mean I made all the money in the world because I solved the market. It basically means that I understood enough well enough to apply myself to going forward. So what we're going to do is try to find areas of commonality, and you'll find that there's really quite a few. And over here on this list, I have 3 things that we're going to try to accomplish out of the class that are basically old but new in terms of trading. So one of the things is you want to trade as close to volume as possible in the marketplace. So this is one of the things we want to accomplish by when we get done with the class, that you're trading as close to volume as possible. And as a trader, I came from California in '63. I wanted to be on the floor because I could trade bigger and get out of the trade if I was wrong than I could off the floor. So in that sense, I was closer to volume. The people that were trading on the floor that were standing next to a broker were closer to the volume. People that were leaning on a spread order were closer to the volume. So being close to the volume is something that has sort of been lost, but it is an essential, as you'll see later, to being successful in a price discovery market. So this is not to be laughed at. I mean, everybody that came on the floor found, something close to volume, and that's why they succeeded. The second thing, which is a big change that takes place, is the direction today is self-generating, and it doesn't have to overcome anything. So what I mean by self-generating, once the trade is on, the new orders coming in are going to drive it higher or lower. So look at the grain markets today, they're sharply lower, and if you wanted to buy a real good price lower, the question you had to ask yourself, is it going to self-generate higher today? And this is probably my biggest problem in overcoming trading, because I'm looking at it as an attractive price, and I'm going to go in there and buy it because of an attractive price. But if you ask myself, the question is it's going to self-generate higher, I'd have to say no. So we're backing off more trades this way, and this is going to hurt the liquidity of the marketplace, but it's also going to improve your bottom line when you learn that. So just remember that it's the self-generation of orders that causes direction. And in the past, what we had is the market basically was ensconced in a fair value range or price, and it was strong in terms of trading. In other words, so any change that came in had to overcome the market. So we're used to trading data where the market acts really strong, and then it's going to overcome the present, which is the establishment of the price mechanism in place at the marketplace. And that doesn't happen anymore. So the idea, if the market acts really good and strong, it is not taking anything out, and that gives it no real credibility beyond its own life, so to speak. So we're used to the market going up and coming down and retracing and holding. That's no longer in the ballpark, so in terms of doing that. Okay, then the next thing you want to do is trade new orders, not new prices. So when we were trading on the floor, we were trading new orders, and the idea on the electronic exchanges, you can trade new orders just like you traded on the floor, but most of us are trading new prices. If you're trading new prices, you're really late when it comes to the market. You should be able to trade new orders, and if you could trade new orders, you're picked up a lot of speed as it relates to the marketplace. So these are the three things that we want to leave the class with and be able to pull out of the electronic exchange this information that we had. All right, now understanding the market is very important, and most of the things that are written about markets are really not true in the academic world and anything else. And it's the practical part of the markets you have to understand. And the big thing is that if you come and look at this from a historical standpoint, there were 4 distinct databases that we've gone through since 1800. The first one was price to price, when the farmers would have a little bit to sell that they couldn't use, and there wasn't a world market, and it was sold local, and they called up the guy and they made a trade, and that wasn't recorded or gone anywhere. Then, as the agricultural industry started to go to the cash market, the exchange, the buyers got inundated, because at harvest time, the market would just go down, 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 down as people were selling. And then after harvest, when the market started to rebound, none of this would come back up. So the idea is that we then had a supply to price market in terms of the market, because supply that was there really forced the prices lower or higher. So it was harvest time, those prices were going lower, and then just before the harvest of the new crop, the prices would go higher. And that was a problem that the marketplace needed to solve, so they came up with the idea of the Board of Trade and the market. But I refer most to the Board of Trade throughout this, but they're sort of synonymous with other exchanges. Okay, so then what they did, they changed the price to the database from supply price to price time. And the first thing that the new exchange did was create a time frame called the seasonal. So we had a seasonal break in the market, and we had a seasonal rally in the market. And that was the initial time frame, and that's why the database moved to price time. And since 1848 and that organization, the growth of the exchanges has come from more and more time frame development in the marketplace. So we had more and more time frame developments. It didn't come by a grand design by an executive committee or board of directors. It came because you had an opportunity to make some money, because you could basically buy this and sell that and you had your little niche. So we at the Board of Trade, we probably had thousands and thousands of different time frames under different conditions, and that's what really led to the strength of the exchange. So the exchange was a service organization providing a time service, and the reason time service was needed because supply and demand are not necessarily together, and the role of the exchange is to bring supply back to demand in balance. Okay, and the functionality of the exchanges was to move this through time frames back to the present tense and create a fair price. All right, now that's a lot to swallow, but the idea is you understand that a price time database have time frames, okay? And then we go to the current one. We do not have time frames anymore. We don't really, I mean, in essence, because time frames define somebody who's willing to buy it today with a little bit of pain to hold it tomorrow. We don't have too many of those people in the day. And when I first came here, I held trades for 6 months and then 4 months or 5 months. Now, basically, half a day is long term in the thing. And if we're going to bring the market to a full fruition, is that we have to develop time frames from the electronic end, which we're going to do. I'm very, very bullish on the markets and trading because I think it's the best business in the world to be in. And we're going through a transition stage where we're moving from one solid, enterprise to a new one we don't quite understand. And when we make that transition, it's going to be gangbusters up in terms of what we can do in terms of earnings and everything else. And the question is just getting through this change period that we have to go through. So that's the purpose of what I've been working on, and I've been working on it for about a year. And I was working an automatic trading program, and this opportunity came along, and I sort of ducked that one and took this one. Now I finished this, and we're ready to begin to start marketing this. All right, now the price time database, in order to bring supply back to price, we have a floor exchange models. And the first thing is we have the order flow that was basically random in the marketplace. Some buying, some selling in the marketplace, or it could be a lot of selling and a lot of buying in order. But most people think it's random. Then above these random orders, we had time frames willing to sell the market higher, and we have time frames willing to buy it lower. And these time frames are the most important part of the market because they give it stability in terms of its price movements, okay? Because we have the time frame involvement. It's not just price, it's the depth of field of price, which is composed of time frames. And over here we have the locals, and the locals' job was basically to provide the basis of price rationing. And on our day on the floor, basically the local capital, cumulative capital, was greater than any order. So consequently, as the market moved up, the locals would sell more, buy less. As the market moved down, the locals would buy more and sell less. And the locals and the time frames worked together because the local knew he could dump it off into the time frame, into the marketplace. And collectively, then, the time frames and the locals are the one that provided the rationing process. So we know that supply and demand is a long ways apart. In terms of time, well, the price rationing, we know we're always going to have some type of carryover in the marketplace, but it isn't right now when I'm short. So the local community and the trading time frames are the one that applied price rationing to the market. And that was the key then to establishing what we call a plurality area in the marketplace. So what happened is, as the market would start trading, we would run up or down. Let's say we go up 4 cents and go down 4 cents. Just hypothetically, we could have gone up 8. But the idea is the first step that we did, and why we had an hour change in market profile before we started trading, was we wanted to see where the time frames were. Okay, once the locals got a sense of a time frame, then they would sell against this top and they would buy against this bottom as the market rotated back and forth. So then once we had these people involved, they basically were involved first with the locals. And the thing about the locals is serving the time frame at the Board of Trade, if you had your order in and the market went sellers, you got it. I mean, you were filled, okay? So only at the extreme price, at the top and at the bottom, would any resting orders or time frames not get filled. In between, everybody else was filled in the marketplace, which was a great service, so people could fill their order in there, and they weren't going to get 50 out of 100. If it was a full price, they were going to get everything they wanted, and that was the role of the locals, to basically fill them up and shut them up in a way. And they did that. And the locals were really a terrific institution as it relates to the service that we were dealing with. So then as you came out, we basically then found that we had more and more trade concentrated into the marketplace, and that's what really gave us market profile. Now this volume area that evolved could be a little bit higher, a little bit lower. We could have a different, not a perfect profile, and those adjustments were basically related to how much time frame influence that the locals were able to understand was in the marketplace, and they were very, very good at understanding that. So the idea is that we were able then to establish a fair price in the marketplace, and the thing that was really amazing was that if we had the fairest price on the board at all times, we were always going to use more supply than was forecast. Okay, and remember, supply is a function of infrastructure. So one of the things that the agriculture market has done here in the last 50 years, we've been the Walmart of the world. We've been selling at lower prices around the world, and they have shut off their infrastructure. So even Brazil, which is probably the biggest competitor in terms of agriculture, is still short of infrastructure. And we had a surplus of infrastructure in the past, and now we don't have it anymore either. So the market basically is more free to run than it was before, because supply is more in question than it ever was before. And then also, if currencies fall apart and things like that, if grains become a store of value, which they will sometime in the future, then we add another complication to the market, that a carryover really isn't a carryover, it's not available to the market. So it'll be a statistical carryover. So there's a lot of adjustments we have to go through as we go forward. But just understand that supply is a very inelastic part of the market. So if you want to have another steak at Safeway, you got to breed the cow, get the calf, get the feedlot, take it to the slaughterhouse, get it cut to packer, get it packaged, get it to the store. All right, so supply is the reason we have the local community in the time frame is to bring supply back to demand. And that's the function of the marketplace. Okay, now what we find is that we have the price ratings, we have the time frame, and if we take away this activity, so if we take away the locals and we take away the time frames, we're going to have a limit up or limit down day like we did today. And then all the volume is going to be at the top of the range, and all the volume is going to be at the bottom of the range. And this is going to be a concave with lesser volume. So if this was 1,000, this would be less than, and we come back down to 1,000 at the bottom for balance. So this is the new structure of market activity, and it doesn't have to complete itself. If it doesn't complete itself, it basically is very rapid in terms of market's movement. So understanding, if you can pick out where this is, then you have a distinct advantage in terms of controlling your trade and controlling your future, understanding how much opportunities in that particular trade you have. And then what you do versus the difference here between this is that if in the Board of Trade we came down like this and we had one value area, which is part of market profile, today what we have is we have all these different supply areas in the marketplace. And why do we have 6 or 8 supply areas in the marketplace today instead of 1 versus yesterday? Because we don't have any supply services like we did before. All right, now, if there's more supplies in the marketplace, that means there's going to be more movement to the market, and if you can trade close to supply, then you're there, okay? Now, what we're going to talk about a little bit here then is the price-to-price time frame offered full price discovery. Okay, the electronic markets offer 50%. They offer a chance at full price discovery, but if you're going to trade successfully, you have to trade a 50% price discovery. So full price discovery means if the market's down 3 cents and I'm the first guy there, I buy it. All right, and then I'm looking for the market to say, boom, 3 cents higher. That was a great discovery on my part. If it's 3 cents lower, it wasn't so good. Okay, if the market, other people started trading there, it was okay. But I made that price discovery blind in the marketplace. Now, in terms of people standing next to supply, if I'm standing next to a broker and the broker's bidding for 500 contracts and I'm bidding with him, am I making a price discovery trade or a 50% price discovery trade? So if you take a success on the floor from orders, the activity, the organization of an individual, all the successful people on the floor really didn't step out for 100% price discovery all the time, because you wouldn't make it. There's too much risk in that. So when you're trading electronic markets today and you're trading prices, you're assuming a full price discovery obligation. And I think that if I go back and look at the floor and all the people that were trading there, I don't think that any of the successful people very often made full price discoveries. I think they were less than full price discoveries. So I'll give you another example. So let's say beans are trading at $5.25 and a big trader comes in and buys 5 million bushels. And the market's unchanged. Everybody in the room here would sell it, wouldn't you? Okay, let's say, for instance, that you made that trade before the 5 million. You made a real price discovery trade. Okay, now if you made the trade after the 5 million, you made maybe a 20 or 30% price discovery trade. Okay, so what we're trying to do then, if you're trading near the volume, you have a chance then of reducing the full risk related to a price discovery. And that's one of the big mistakes that everybody is making, including me, because when corn is 15 lower and I'm bullish, I buy it. okay, and I'm the Lone Ranger, so I'm not big enough to say, okay, keep selling it to me. So if it doesn't work, I'm out right away. But if there is volume there, and there's going to be people willing to buy and sell at that price, I at least get a peek at it before I get my demise on the particular trade. So I think you need to understand that is the big thing we have to attack in doing electronic markets. And a lot of you were never traded on the floor before, and you had a different methodologies. You had the sound economics on your side, or fundamentals, or you had capital, or whatever. That all comes into play. But for those of us who like to trade with little or no capital, the key thing is to not get into the complete price discovery mode. Be less than that, and then you're in good shape. Okay, we're going to then take a look at a little bit more here. I'll go forward in this as I can, see what I have on here. Oops. Okay, and the thing we want to do is the central issue for today's trader is risk related to the whole of price discovery, which I've covered that. The issue is price time formats instead of the information coming from electronic front ends. Okay, so I'm sure that Kurt here and all the staff he has and all the good speakers he has are giving basically the programs that were related to the price time database, which are no longer valid. So that means market profile, moving averages, bar charts, or whatever. You have a big handicap because the market's not doing what your format is. What the format you're looking at. And the key thing is to get back into where the two mesh together. And that's what I'm saying is we're in a short little period of 2 or 3 years of adjustment where the market begins to really move forward. And also that we're coming in where the exchange today, the blueprint of the exchange today is back before the exchange was formed, because there are no time frames, there are no services. So if we took the cumulative volume of the exchanges before they merged, we did about 40,000 contracts a day. And now they're probably doing 12 and 15. And what they're missing is the 25,000 coming from the local traders who were providing service. Okay, so remember the board trade grew because it was a service orientation, and there was a slot for you and you and you if you came down and applied yourself on the floor to make the market better. All right, now the idea of the fee structure of the area when I was in the exchange wasn't very high. We were higher in service, low on fees. Okay, what the exchange has done now, they've taken the fee part of the business and tried to grow it. You can't grow a fee business. Okay, you can grow a service business. So take a look at Microsoft. Microsoft basically is a fee structure business. It's not going to have a lot of growth. Take a look at Apple, which basically is a service-oriented one, or take IBM changing from fee to services. So services would grow, and I'm very, very bullish on the exchange too, but I think that they're going to have to realize that they need the services that the individuals provided, and I would say that in a couple of years, if my program begins to work and permeate through the marketplace, is that the trading rights will be substantially higher than they are today, and the stock will not be as high as relationship. There's more money in trading rights because this is the area the market has to go to. And not that the staff or people at the exchange aren't bright and capable. This industry is the best industry because it'll turn on a dime. Believe me, I mean, if they find the right thing to do, they'll head right into it. So it's just a matter of finding the relationship between trading rights and the fee-based structure of the exchange, and the two go forward. But the idea is if one is going to survive, it's going to be the fee-based people who have, the service people who have the right to trade the product. So I'm very optimistic in terms of the latter. Not so optimistic in terms of the former right now, but I do think that they will basically change and shape up. So if you come back and take a look at the scope of what we're doing, this is a very, very large scope. So I remember doing market profile and the exchange, and the reason I did market profile because I was in the bean pit, and the buy brokers and the sell brokers representing the commission houses never did equal volume, and that's how I figured that out, and then I came to the formality of market profile. But that's how it started, and it was really fundamentally sound. It wasn't really as good as this that demonstration I showed you, but it was there. The second thing I did was we did liquidity data bank and CTI codes. So I remember being on the floor when CTI codes were being rumored, and had two people from New York grain houses, not Minneapolis, accost me on the floor because it was a rumor. And he said, we understand you're going to come out and reveal our positions in CTI codes. I said, that's right. So they got right in my face and said, we're suing you, suing the exchange and everything else. So when it came out about 3 weeks later, these guys were first guys getting it, and there never was a complaint. It really was a service that people decided they wanted to use. And so these were, the transparency coming off the floor was something the exchange needed to do because it was going to create more time frames and other people trading. And that's why we have open lows, close, open interest, all these different things, because it gives people different time frames. And that's the role of the exchange, is to put out more and more information. And the problem we have today is no one's paying attention to the information coming from the electronic front ends. Okay, so then what we're going to do is we're going to get away from using the price-time formats in terms of the marketplace, and we're going to understand that the time database, the time price database, I shouldn't say price here. Okay, this is a time price database, which is almost a supply database. So this is basically, the database we have today is as close to the database that we had before the exchange was formed, because we're getting no service related to supply. So we have supply, and then we have price. So then if you're trading, we're not going to go price time, buy the price, hope that it goes later. We're going to say, this guy's got 500 to sell, I'll help him sell it. Or he's going to be right, I'm going with him. So the idea, when you tie yourself to supply, in other words, you are at the front end of the new thing, because time and supply are equal in the academic world. So we're going to call it, just for our purposes, a supply orientation to trading. And then when we have a supply orientation to trading, the price discovery process is not 100%. It's going to be less than 100%. And we're going to be able to operate it. So there's no one, I don't think, in the world that can operate with full success over a period of time, assuming full 100% risk. And that's what everybody's trying to do. Okay. And when we move that back down to less risk, we're going to make more money. So one of the common things that people don't realize is that the more risk you take, the less you make. Okay? The less risk you make, the more you make. And so the idea in trading is you take the smallest amount of risk possible for the largest gains. And in this environment we had over here, the gains were more one-to-one. In other words, this example where a dollar put up maybe made a dollar back because the markets were somewhat efficient. Okay, and we could recover from our losses and gains. And in order to make money in that environment, who made the most money were the traders who had the biggest positions. Okay, the people who were able to have a big position on when they're right and a smaller position on when they were wrong were the most successful people on the floor. Okay, so what we're going to look at then is that this is no longer one-to-one. At times it's going to be 10-to-1, and at times it's going to be down to the 1-to-1, 2-to-1 category. Okay, so today if we're trading these old formats, what ratio wins the loss are we trading, because we're very cautious and taking our time in terms of making trades? We're down in the 1-to-1 category, 2-to-1, 3-to-1 category. So if I look at my trading record the last couple of years, I'm saying is my best win is 4-to-1, okay? And when I was trading on the floor, my best was 40-to-1. Okay, so the reason is because I'm waiting for all the juice to get out of the trade, and it finally settles down and to make my trade. So when you came to the Board of Trade and you were a new trader, where did most people go? They went to corn because they didn't have, there was no volatility, a lot less volatility, and they could learn how to trade. The people that were smart went to oil, beans, and meal or someplace else and learned how to trade into the volatile markets that we have. So you can't put your toe in the water, and in this market you got to dive in. And one of the first examples I learned was, I was here in '63, and I was very cautious. So meal market was real strong. October meal was going up, real big. So I'm trading new March meal, 6 months forward, and it's moving up $1 when the October meal is moving up $5. And then all of a sudden October meal breaks $5, mine breaks $7. I said, get into where you belong, kid. There's nothing, you cannot not jump into the pool in terms of doing that. Okay, so what we're going to do now is we're going to look for the common areas in the marketplace. And this old marketplace, we had a common area of trade. And the role of the exchange was to get every time frame it could involved in the marketplace. And when we got involved in the marketplace, then what would happen, the market would basically change, and we would look at it like this. So let's say, for instance, we had a trading range where the market went up and down like this. and we had our time frame trades above the market. And so let's say as the market went up here, time frame traders sold 100, okay? And let's say here they sold 50, and here they sold 10. Okay, now as the market came down, they bought 100. And the market came down again, they bought 100. The market came down, they bought 100. Okay, as the market goes up, then what happens is we have this total involvement in the marketplace, which is supply, and the market is going to have to move away to less than. And as the market moves away less than, that means that these buyers may move up their orders. There's no selling here. These shorts are already short. They may want to buy. And when we get up here to where the market's at the top, we're going to have less than volume of open interest than we did down here. So the market always moves away from an involvement area. That's why we always trade the value area. So the lower the value area, the higher value area, or the value area, moving away from the value area, because the job of the marketplace was to get everybody involved in the marketplace. And then once they had that price, somebody was going to be wrong, okay? And that somebody would look to buy, and then that would basically reduce this open interest. Say there was 100,000 people long or short in here. As we got up here, there'd be 85,000. Okay, and that's what causes the market to move. So if the total involvement in the marketplace by a group that becomes all of a sudden necessary to be less than in the marketplace. So what we're looking at is that we're looking for the volume in the trade, and we're looking for less than volume to come out of that as the market to move. So for instance, if the market's moving up and somebody bought 1,000 at 2, and then someone bought 1,000 at 3, and he bought 1,000 at 3 1/4, and 1,000 at 3 1/2, I'm not moving away from anything, am I? But if someone bought 1,000 at 2, and then there's only 300 for sale at 3 and only 150 for sale at 4, then the market is moving. So the idea is that if you can find an area where people are involved, okay, in the marketplace, there's going to be a natural movement away from total involvement to a less than involvement, and that's what drives the market forward. And these are common in both marketplaces, okay, in terms of doing that. Okay, and then as the market moves higher, what happens is that a lot of people down here, you know, that wanted to buy didn't get filled. They can move their orders up. The people were up here that wanted to sell, they're canceling the orders because they see the market going. These are all things that basically are happening in the market. Now, the locals were really, really some of the best traders in the world. I remember the Falkland oil crisis, the Falkland War crisis. That was something, and market opened like at 90, went down to 40, and was coming back, and I was long 100 at 70, and I got whacked on the way down a little bit. And the market moved up, and it was trading at 91 bid. And it was 91 bid by 25 locals in the pit with their hands down. 94, 94, 94. I knew everybody was long. No one's putting their hands up. You couldn't sell 10. I mean, like that. So finally I said, sell 100. Someone says 89. I said, sold. Pew, down she goes. But I mean, the locals were smart enough. They were all long. They weren't putting their hands up and say, for 100 or 50 or any quantity. And it went on for 2 or 3 minutes. So, I mean, they were very, very adept at basically using the long-term trader to exit their position. So if the market was down 2 cents, locals are buying it. And they were the original discovery people, hoping that or knowing that the longer-term time frame trader was going to be there. If 2 hours later the market's trading at the same price, they're going to go if they haven't transferred that to somebody else. What they're going to do is if they're long $1 million 2 cents lower and the market's good, they'll be short 100 or 200 before it starts to take off. But they're good enough, quick enough in order to handle it in terms of the trading. So the idea is we're getting away from that, and we need to go to the new. So what we're going to do is I have a handout here to give you, and we'll go through the handout. But first, I'd like to have your questions of the background that I'm talking about. The background of basically right now, the exchange is a supply price market. And you want to land on supply and not price when you make your trade. The program we had on the floor was price time. We bought it and held it for a period of time. That's a two distinct different formats. And next, the latter one here offers 10 times the opportunity that we had before. All the economics are now in favor of trading versus we really weren't trading in the past. We were providing a service and getting paid for it. Also, we were allocating. So if I happened to have 100 on and be right, and then I had 10 on, I was wrong, it was really an allocation process. And one of the things that was really good about the exchange is that we had a solid price background. And so we could look at someone coming in and buying a little bit and making the market move and say, yeah, this thing isn't as strong, needs to overcome. So I could basically make a judgment in terms of trade. So one of the things that helped me in terms of trading, I was probably wrong more often than right, but not in big positions, because if I came in and I bought a lot and it acted lousy, even if it was higher, I got out. Because I knew it wasn't going to overcome what was in place. And what you're looking at is, in terms of the entrenchment, like a baseball team that's in second place, they have a real good team. You're a young guy in the minors, you're batting .350 in the minors, and you're a third baseman, but they already have a good third baseman who's batting about .270, and you're up here, they're taking a look at you. Okay, so the idea is that this third baseman is already entrenched there, and you got to show something to knock him out of the box. I mean, you're just not going to put you in there because you had a. So if you hit a couple weak grounders the right side and you strike out a couple times, you're not going to replace this guy. So again, that's what the marketplace was in terms of price stability. You had to knock it out, and you could tell then by your effort into that knockout punch how far forward you were going. And if you weren't making any headway, you got out. Okay, and that thing really helped me a lot in my trading, which is not available today. So we all have things, we have to find new ways of approaching the market, and the things that we used in the past just aren't going to apply, and maybe they will someday in the future. But I think we can develop time frames from the volume data, and then when you do the time frames from the volume data, we're going to expand the service part of the market. And when we do that, we're going to get paid for providing the service, plus the economics of how good we're doing the job. Okay, do I have any questions about the background in general? Okay, if not, we'll get into the handouts. And we're going to see on the first page of the handout, this is one of the volume profiles. I've been working for volume a long time ago, so I did a program for the NYMEX in 2002 because they used to throw their volume into the center of the pit. And then Danny Rappaport was chairman, and so it's still a beautiful program. And we knew he lost the election, so consequently they killed the program. They paid us, but they killed the program. And that was my first volume program. And they were so insistent that I didn't infringe on the market profile rights of the Board of Trade, and it's not. But I mean, so I've been working in volume for a long, long period of time. And I sense that the market has changed in 1992, 93, and I moved my database to really a price-time database. But to show you in this graphic right here is that we have a formula that displays 20% of the volume out of a certain sample size. And you can see all the volume at the bottom of the range and the top of the range, which is typical of supply-price markets. Okay, it isn't in the middle of the range where it would be if we were trading a pit market. So basically, all you have to do is trade where the volume is and make your mistake. And if you trade where the volume is, the market's going to move away the farthest. That means your ratio of wins to losses is going to be the highest. If you trade down here where there's no volume, your ratio is going to be in the 1-to-1 or 1-to-2 category. So just like limit down today in corn the first time down, that's the place to buy it if you're going to buy it. Take the shot, okay? I don't have the courage to do that, right? But that's what you have to do. So because there was heavy volume at extreme, now it bounced off and came back down. But the trade was not to buy a price 25 lower or 30 lower, it's buy the high volume number, which is basically the limit. And again, once we have high volume, the market is going to change. It can go in the same direction, but generally changes directions as it does here. So anyway, I want to point out to you, this is the proof that the market we have today is going back to pre-price time. So we're back to about 1840 instead of 2011, and we're not even up to 1848 yet. But it's a new ball game, so that is real not a comparison. We have to learn to trade this because we are 2011. So we have to learn to handle this. Okay, so what we're going to do is go read this, and this is a program that you should take home and read. You should be able to understand it, I think. And we're saying that the common denominator through trading is the value areas or high volume areas that occur in the marketplace. And basically, we have a lot more. We had one basically in the pit markets, sometimes two on a trend day, but they were related to each other if they were. And today, we basically have a situation like this where we have all these different volume areas because there's no volume service as it relates to the marketplace as we had in the past. So if I was to do this on a program out here on a time lapse, then basically we'd have one like this and come down like that, and another one may start from here and just go up a little bit like this. Then the next one come all the way back down in here like this. And so these concave things, we get, you know, at least 6 or 8 every day. So if you were, you know, long the beans, corn first time limit down and it rallies up 6 or 7 cents, you feel real good. Well, all of a sudden another volume area came 7 cents higher and boom, she goes back down again. So the idea is that what we're looking at is the speed of the market basically when these fail. Okay, in other words, so you have 1,000 contracts here and the market comes down like this and you only get 500 down here, turns and goes higher. That's where the market is very, very strong and going to run and give you the highest ratio of wins to losses. So your job in trading, when you're trading volume, is to basically get out at a reasonable rate at the 1-to-1 or 1-to-2 category, because volume is there, somebody's willing to buy or sell it. And you, when you're right, you want to close your eyes and let it run until you find an equal volume on one of these basic profiles. So instead of having one profile like we had in the past, we have this, okay? And the reason I like to trade nighttime versus daytime because there's only 1 or 2 at night. So the market will either go one direction or start and stop and turn. So there's only one possible change at night right now. So that's much easier for an old guy like me to trade than the ones during the day where I'm always flipping myself. Also, that in terms of trading change, I probably changed my trading style 4 times in the last 50 years. And it was pretty hard the first time, but one thing was that my financial disciplines always stayed the same. But now, basically, I'm changing my trading style and changing my financial discipline, which is a lot harder. So, I mean, I have to take a lot smaller hits than I did before because I can't hold through time. Before I could say, okay, it's going to be okay, and I'll take a shot, but I can't do that today. So I'm down where I feel stupid getting stopped out of a trade with a small loss. In an ordinary trade I would keep for another, you know, $1,000 or so. I've learned that every time I like a trade and I have my stop too close and I move it down because I don't want it to get knocked out, I just lose more money. You know, it's just how much more do I want to lose? So that's about a 90%er in terms of doing that. Okay, so I'm going to skip here a couple pages and go to the first diagram here in terms of the market, and it's on page 3. And if you look at today, there's 2 pink numbers that are there. On one on the bottom at 87 has 814. All right, now if you're long the market below this number or at this number or above this number, what you're looking for is an equal number to occur at a higher level. So when this reaches 814 up here, then this trade is over. So it went like this. So this is 814, and this we're all less than, and this is 860 or whatever it turns out to be. Okay, now what you're looking at here in terms of this is the complete structure of the marketplace. Okay, this is the structure that you're trading, and this can occur over and over again in the marketplace. And the idea is that why do we want to be lucky? So once the market starts this concave movement up, what's happening here from this low purple mark to the high purple mark? We're getting less involvement as the market goes higher, right? And that's what I said, when you have everybody involved and the market moves higher, you're going to have less involvement. So if we had 860 right above this 800, I don't make anything and I'm out, right? But this 860, 800 up here, it could have been way up here. It could have been a whole handle higher. It could have been $1,000 a contract. So what's really nice about this, I've taken the pressure off myself, and I'm playing the development of the market according to the development market. In our software, this software, I can put an order in to say anything above the price of 1090, sell the first 800 order, and you get filled. I don't have to watch it. And what I'm going to use this for at night on the currencies is because generally speaking, when you get 3,000 in the euro currency, some price during the night, so if I'm bullish in the euro currency and it says it's 25 lower when I go to bed and I want to buy it lower, I got to stick a price in there that I could get up in the morning and get nailed on, right? Because I'm making that trade, I'm making 100% price discovery, aren't I? Okay, but if I say buy the first 3,000 lot underneath, you know, where we are today, I'm going to have a trade that I'm not going to get killed on. And again, what I'm doing there is I'm reducing the risk of direct price discovery. Because everybody successful on the floor basically didn't take on 100% price discovery. Very, very few, and the ones that were there were gone. Okay, so then we want one more little example we have here, and then we'll get into some more examples that are the rest of this. On the next page, we have the same contract, and the high purple gives the number of 283. Now, at the tops and bottoms of the marketplace, okay, at the tops and bottoms of the marketplace, you're going to have natural rationing. So this is 283, and as the market trades less than this, and as it then reverses back underneath it, this is a top in the market, okay? So you're trading back underneath this. So whenever you have the last 4 or 5 ticks and you have a volume and you don't get less volume, a higher volume above, and it gets underneath it, you can't afford to take the chance that this is going to hold. You go on that trade. Same thing on the bottom. So it's a price rationing as we used to look at it in the old profiles, because in the old profiles we had it here by design in the marketplace. So we had lesser volume at the top. They might be big orders, but there was less volume down here in the marketplace. Okay. So the idea is what you're doing now is you want to parse the range as active as you do on the floor, and you want to watch the new orders coming in, which we're going to discuss next. But basically you want to look for opportunities to play the concave development and let the market take you out, okay? Because you're in there, not going to get hurt on it. Once you get less volume moving higher, you're pretty safe, unless it happens to be at the extreme of the market. Then you have to add that into your risk factor in terms of what you're doing. Okay, so those are the 3 basic things that are in here, and the rest of the examples are pretty self-explanatory. And you know, I don't really have to go over them, but we have a second group of examples that I do want to go over with you, and because I think that they are a little more complex than this. And I think if you read the document and you look at the program that we have in place, you'll find that it's going to work. All right, up at the top here at this, we have all sorts of controls over the marketplace. And one of the things that's happening in my account is that I've been getting trades in one account from the last month that all of a sudden I have a trade on. And I finally figured it out today what the problem was. So when we do the strips, you get the strips, you have opportunity to put your trading quantity at the top. So every time you activate a strip-orientated order, you know, you're going to basically have to activate how many you want to do, because this is something new, okay? And this cost me, you know, several $1,000s here on errors doing this, getting caught. So I decided we're going to basically not have that happen to you. So when you're getting used to this and you want to trade from this, you're going to have to manually put that in. We'll eventually take it out, but right now, if you have multiple accounts and you're trading multiple contracts, there are mistakes that'll be out there that you'll make, and we're going to make sure that you don't happenstance into those. It has to be more by design. So there's a lot of things that we have here in terms of capabilities. At the top, it gives you the contract, and then it gives you the contract month. It doesn't here. S&P is somehow missing here in this one, but it usually gives the contract month. And these are different settings that we have to control our trading. So we really don't have to trade off the Cunningham front end right now. We can trade off the strip, which is a very consolidated thing. All right, now the green line represents where the price is currently trading, and all the volume here is a raw strip. So this is just a raw strip as the volume comes into the marketplace. And what we want to do is we want to refresh this marketplace in terms of showing us where the areas of plurality are, and we also want to see the new volume coming in, because we can assess both in the marketplace. So what we do is we have a basis program that's explained in the marketplace, where we take the high volume in this column and divide it by 1.1 of itself, which basically gives us the 99 number. And we divide then all other numbers by the same number, so they're going to be less than 99. And if they're down where they're less than 30, they become 0, because this sort of shows us there's very little liquidity there, and it also shows a way of breaking distributions in terms of doing that. So the first step we do in trading then is to run the basis program, which we did over here in the second column. So we run the basis program, and our 99 number came out to be 126.60. Okay. And we find our 99 number is low in the range. It's down here. And the market essentially is trading higher up here. Okay, what's our risk parameter right now?
Very high.
It's high. Why?
I have a question. Is that 98 from previous days of trade?
No, just what you have there.
How long did it take to create that number as far as the trading day?
5 seconds. And you're going to be doing it multiple times because we have multiple things. Okay, but basically, what is the first lesson we learned right here that we should have learned from the class?
Stay away.
We're pretty far away from volume, aren't we? So this is supply down here. And this is what up here? Discovery risk, because we don't have any trade up there, right? So if I bought this, this could go trickling right down to here and still be good, right?
Yeah.
Okay, so the idea is we have to find some way of basically bringing this activity into play. So what we're going to do is we go to the next page, and we're going to artificially bracket this number. Okay, so we're going to basically create our own high and low around it by doing this. So we're going to come in here, and what I'm doing is I'm going to go 4 ticks up here, and I'm going to bracket the market, and I'm going to go 4 ticks underneath and bracket the market. Okay, now this is still way away from where the market is trading, but this is a discipline we have. So we want to see how the new volume is coming in versus the old volume. So the new volume is a lot stronger in the marketplace. And for us to have a safe trade higher, rather than just buying the higher price, we have to have a little more volume take place. Okay. So then if you take a look at the past, we're at the same thing, and we have 7,800 trade come up here. So we now have 7,800 trade. So we are closer to volume at that price. Okay. And then we do the same thing here in this example. What I only did it once, but essentially we're going to bracket this price the same way. So we're going to go 4 ticks under and 4 ticks over. So we have an idea of how the new volume is coming into the marketplace. Okay, so this is high. So once we have the 7,800, then I don't mind buying this because there's enough people up here who were short that are going to cover this, and I can take a small loss. So I'd be willing to buy lower here in terms of the market. All right, now if this market is very strong, and I was talking to a friend of mine, and we were going over this example, and the market shot up about 15 handles, and you know what his question to me was? He says, I never got a chance to buy it. Well, what I'm saying is, if the market is good, it's not going to let you buy down here. You have to buy high or higher than this, and the idea that you're looking for then less than volume than 7,800 going higher. So if I buy it up here, and this is a fair traded area to start it, I can say, okay, if I get 8,000, and it isn't, if I get 8,000, I'm going to get out. So if the market's good and starts up, it's not going to get 8,000 for quite a while. But if it gets 8,000 in the same range, I'm saying is, I'm really only buying price control here. I'm not getting any leverage. And if price is in control, I'm getting a 1-to-1, maybe 1-to-2, 1.2. What I'm looking for 4-to-1 or 5-to-1 in terms of trade. So you can use this volume then, once it starts building, to exit your trade in terms of exit parameters, and we have some examples that basically show that intuitively. So the idea is the red mark here is what we're after in terms of the market. Now, what I did here in the next one was I basically redid the program to answer your question. I did a new 99 that was higher, and I kept off the high volume numbers, but I first, this one came before that one. So this was the one that came before that one. So the idea is once I didn't trade this one, once the volume gets to 7,800 or whatever volume fits that particular contract. So S&Ps are about 25 to 30,000. Currencies maybe 3 or 4. Grains sometime up to 10, but generally about 3 to 4. You're going to find those areas. So what I'm doing then now, why am I marking this up even if I don't make a trade? Because potentially what I want to do is trade new orders. I'm trading new orders, okay? And I'm saying is once I have a base and I'm trading new orders, I don't care how high it is, it's going to move from that base. Okay, the base is going to move away with less volume. So then what I'm looking for in terms of this is this market to keep going and have lesser volume as we move higher. Now, if we end up with 9,000 contracts up here that is higher yet, I just move my thing up there and trade that. And what you want to do is have the market, as it's moving your direction, you want to have higher volume higher, because then you're getting acceptance and you're moving your value areas, your plurality areas higher in the marketplace. Okay, we'll come here to a more exciting one, which is good at the end of the S&P. So we go to page 3, and then we'll take our time. But okay, on page 3, you can see here that I have 99 area, 73, 75, which is red, taking this first example here. And I basically, another one at 72. And where the purple mark is, I have 28,000. All right, now, as the market, notice the time up here, it's about 2:15. So the market is in a time zone where it can run. So I'm saying is, in this particular trade, I'd be short, and I'd be looking to cover 28,000 as the market on a price going lower. So if the market dives from here, we're not going to get, it goes down like a couple handles. We're not going to get 28,000 until we break about 10 handles. All right, now what happens is on the next thing, we get 28,000, about 5 ticks off the bottom. That would complete my trade. But the most important thing, if you look at your green dot on that one, the 28,000 number has turned to what? The higher 28,000 number has turned to what? 39,000. Okay, now the idea is, and you can take the other number, so this, as the market was coming in, the market had rejected the end of this profile, end of this program, like this one was here, came down, we had 28,000 here and 28,000 here, then we're plus 10,000 at that price. So what do I have here in terms of the market going into the close? I've been saying is, well, if the market failed to break, I'm buying this, and I'm not looking to buy a setback here to buy it at this level, right, which we all tend to do. You have to buy that at the market because the market's going to run or has a chance to run. And if it doesn't run, the volume should build even more. So I think it closed around 73 or 74. Night session got down to 71 and a quarter and built another 4,000 volume there at 74, and then was 85 when I woke up in the morning. So again, what we're doing here in all this is we're taking the basic principle of staying close to volume, and we're taking the basic principle of not doing 100% risk on price discovery. Yes?
Can you go over that example again? You said in example 5 you were short from 72, 75, correct?
Yes, because there's 28,000 there. And we're in the middle of the range here between this. And if I sold that, I'd probably have my stop up there at 74 and a quarter, okay?
And then as we move this example...
And we were moving down, I'm saying is, where do I cover this trade?
Right, and you would say...
So if it's Pete Steidlmayer doing impromptu stuff, I say, okay, it's down, I got $150 profit, or I got $200 profit, I'm going to get in, okay? But if I'm letting the market dictate it,
on this, initially in 6, you would say it hit 28 again, so I'm out, but the new reference level is 39, so you're...
No, that's after, that comes out, that came about after this completed itself. So, okay, we did 28 to 28. Okay. Now let's say the market basically didn't get 28, did not get 28 down there. Let's say it got 20 and came back to the 28. It didn't complete, so it basically is minus development. It's going to run.
Okay.
And so there's nothing different.
You see lower volume as you're involved?
Yeah, this is a little. I mean, this is a little complex to do, but in the handout we did the 800 on the Canadian dollar, right?
Right.
Okay. All right. So this is a little more complex of the same thing. And if you get yourself in position to trade basically development of the market, which is this formation, you know, and that's why you keep running your 99. You're going to pick up these things all the time in terms of doing that. So the idea is that the market's going to move away at a faster pace from any accumulated volume. Why is that? Because the accumulated volume is bigger than the trade that's taking place. So if we come down like this in terms of volume, okay, we have 100, 100, 110,000 in the marketplace, and some of these shorts want to cover, okay, in terms of the marketplace, they start up. Okay, now what's going to happen to them with no liquidity in the marketplace, no locals, no time frames, is that they have to bid the market up, you know, at a faster rate. And what I'm saying is these people are bigger than the market. So when you're trading a volume area, it's basically represents a trade that's bigger than the rest of the market, and the rest of the market is basically diminutive to it. So consequently, these guys are in control, and they have to attract new. They're already trapped in here. They got to get on the phone, call people that are going to sell this. All right, now the issue is that you do all this with your number. The basic fundamental you want to remember. The basic fundamental that you want to remember is, will this trade self-develop? So when you're making a trade here, will this trade basically self-develop? This one certainly has the opportunity to self-develop. So this is the question you ask yourself, and I'm very, very poor at that question. I mean, that's probably the biggest hang-up I have in terms of applying myself to the marketplace. So as the markets evolve, I understand what I should be doing. I have to learn to do it. And remember that financial business is always less than. I mean, we don't make more than, it's always less than. So the idea is that I have to stumble along and gradually get better over a period of time. And I'm going to get better over a period of time. So 2 or 3 years from now, I'm going to be rolling. 2 or 3 years from now, you could be rolling. 2 or 3 years from now, the exchange could be rolling because they identified this. So I talked about scope before. What do you think the scope of this project is? The scope of the project is that the exchange has always put out information so people could trade and create time frames. They do that with prices, okay? They sell their price quotes probably for over $200 million a year. Okay, the reliability of price quotes to put on trade is what? It's 100%, in other words, you're taking a 100% chance on price discovery. Okay, this reduces it down from 50% or less. Which is the more valuable of the products? So the size and scope of this project is going to be huge, okay, for you, for me, for the industry, and that's what's good about it. So it isn't something that's in the corner. And what I'm saying is, what you have to do. One of the problems people have, what I come out, is I set out parameters that you don't want to reach to. You just want to make a little bit of change. Today, merging from the exchange-traded pit markets to electronic markets takes 100% change, not 5%. And you have to make that decision that you're going to do that. And once you get into this, you're going to be able to do it more and more. You're going to be able to see it. So what I do is I run the high volume number. I put my brackets. Now these brackets can be, instead of 4 above, I might put them 8 above. Okay, I might put them 2 below or 6. I can do any combination. But the idea is I want to bracket the new trades coming in so that I can see how it basically is unfolding in the marketplace. And then as I see it unfolding, I may see a number that's 12,000 and the market's above it. I say, I'm going to buy it high here, and I'll get out when this number goes to 15,000. So I'm basically, because it's not going to leave that area, it's going to trade there for a while. So these are all judgment calls that you're going to go into by using increased volume for you to get out of the trade, because increased volume in your area reduces the volatility that you're gaining. So instead of being 4-to-1 trade, it becomes a 1-to-1 trade. Because once you have a lot of people involved, it's the same thing as the big trader in the pit wanted the whole order, because when the broker bid for it next time, he wasn't going to get any. Versus if you go 100, 100, 100, 100, 100, 100, 100, and I come in with a buyer, I got 18 guys willing to sell to me, right? So the idea is volume concentration, and this is why the big trader has the advantage. The price discovery process for a big trader in the short term is very low because he has the volume to make it. Now he has to be right, but he isn't going to get hammered like we are. So the thing you want to work on is you want to work on, will the market self-generate higher? So if we're coming down today and we got a couple thousand in terms of corn, 5 cents off the limit, I might take a little stab at it. You know, if the market got higher, I wouldn't buy it lower, and then stop out at the 2,000 level. So I'm going to take little shots into the marketplace there. So this is not, you know, this is not rocket science. This is very simple, basic things that worked in trading for generations. Okay, and it's the same thing everybody does. So I mean, this is not hard to do. This is easy to do, and this program is going to help you apply yourself to the markets on a constant basis. So you're going to be constantly parsing the range, looking for highs, looking for lows, looking for new volume, and you're going to have a basis then for making a decision. So the idea is, if I basically covered this at 28,000, I had a reason, a market reason to make the trade because we completed the concave distribution. And if I didn't get filled, okay, I had to be willing to say it only got to 20,000. Well, I'd be buying at the market when I covered and go long. So you also have to make the trades first. So the longer you hang back in the marketplace, the less ratio you get in terms of trading. And so that's basically that's the same that there always is. So I do think this is a good program, and see what time we got here, and we'll take some questions. But the idea of this program is going to be, Bill Cunningham and I have a patent pending on it, and it's going to come out on Cunningham. You probably should get it like Friday or Saturday. We have a few bugs. We have a website, Cunningham Services, that'll have PayPal on it. We will be getting on Onyx pretty soon, probably, and then get on TT sometime in the future also. But right now, Cunningham is our only front end that we're servicing. And this is an app, and it costs a little more than $300 a year. Which isn't very expensive, but the idea is we don't let you test it. We don't give you refunds. You just got to decide you're going to do it and go to work, because it isn't one that I want to spend time teaching everybody how to trade in terms of doing that. $300 a year. Yeah. Okay, now the reason it's priced low, because I think that everybody has to do it, and I also think it's going to grow the industry. Okay, so the idea is that this is a package that you can pay for and pay. So service fees should be low in relationship to what you could gain. So I think that this is going to be worth $300 a year to you. And we will try what we can to do to help you. Now remember, volume is not as accurately monitored in the market as prices are. We have time and sales and everything go back. So we're hooked up to the volume, and servers, Cunningham has 2 volume servers, and so one volume server will give you different volume than the other. We put spread volume in ours. So the volume is not going to be absolutely 100% perfect, but it will get better, because no one's really putting volume out there in a format that, going back to things. So we just take what comes in and we put it on the screen. The only time the market really degrades is when we have spreads at the end of the time period, and so they take a price from yesterday, and they wheel all the spreads at that one price, and then you get a lot of volume there. That's only a day or so was there. So it is not, I'm not saying the volume is bad, but I'm just saying is that, the volume is not like prices in terms of prices have time and sales. Volume doesn't. We can't go back and check what was there or whatever. We just take what was there and put it on the screen, and you have to sort of live with that. Yes?
Is there a value for including spread value?
Can you repeat
No,
the
no,
question?
I think there is a value. Yeah, I do think so.
Good question.
Okay, so is there a value including spread volume? The answer is yes, because spreads really control the market today more than direction. So if you take a look at the corn market, it's the collapse of the spread that brings the market down. Okay, or if the spread was really strong, it's going up. So the spread volume, I think, is a tremendous asset to this. So you're going to see much bigger numbers than you do in Cunningham. So it's like 3,000, and they might have 1,500 because they exclude it. But remember, no one has done spread volume, price volume in this manner of breaking down like we have. So that's going to get a little better. But I do think spread volume has been an advantage to this, and I intend to keep it in there. Yeah, yes?
Pete, what's your opinion about how you relate to the high-frequency trade in the
Well, the high frequency, how do you relate to the high frequency trade? Well, the high frequency trade, what the exchange is going to do is that they're creating a center in Aurora where they have a lot of capital and want to make the trade into the millisecond, okay? And that means there's no time frames. They wipe out every time frame. So even though the customers want it, it's not a good thing. But the answer to your question really comes from, we let them make their trade and we see where it is, right? We're not racing them, we're not fading them. We're saying there's enough volume here coming from high-frequency traders that some of them are going to want to get out of their position. We have a safe place to trade. So the answer to your question is, we do not want to assume 100% risk of price discovery. And I think that answers your question. It's a very good question. Another question? Yeah. Don't be afraid. This is your opportunity. So, yes.
What if you're trading on a different platform?
If you're trading on TT, well, we eventually get there. Or
About CQG or something?
well, CQG might have it, but they haven't. They haven't. They have to make an agreement with us to do it. So this is right now going to be available on Cunningham front end, and then probably TT and Onyx, which is Rosenthal, and CQG I haven't had any contact with. But I mean, I'm not against them licensing it. And you could probably, take this stuff and do it. If you're trading one commodity, you can probably guess it, for a while. But the idea is, when you have 8 changes during the day, which you're going to have, you got to refresh it all the time. So refreshing and restarting is very important. Now, Cunningham has a program where you just pay $25 a month, or I think that, I mean, he's at a funeral today, or he'd be here, and then I think Dave has it, and he doesn't trade on, so that's all you pay. So you pay that, and you pay $300 and $300 you get it on that front end. But it'll eventually get there in terms of more display, and I think that there's tremendous opportunity, even for the exchange, to buy us out and take this, because this is a primary thing that they should be concerned about. So it's going to spread, in terms of going forward. Yes.
So just to clarify the process, you want to be involved in the high volume area.
Yes.
As the market goes in your direction, you want to see lesser volume.
Yes.
Until you reach another high volume area and get out.
Yeah, you want to see lesser volume unless you get a higher volume higher, and you can do the whole process again.
So when you see the same volume, you don't want to immediately get out. You want to see if it's going to.
Yeah, you're going to gain experience in terms of doing that. So. Yeah. So if the market's going higher like this, and you're long here, and you get a high volume number here, that's great. I just don't want the high volume number here.
Correct.
Yeah. So then what you do is you bracket this number. Okay. And then what you're looking for is higher number again. Okay. And that's going to take a period of time. Okay. Or a reasonably good number. But what you don't want is you don't want to have a go up like this, a higher number, which is going to be a low number. So I say, I mean, you don't want to really have a low number. So this is 2,000. This was 1,500. This was 1,000. You don't want to see 100 here, and then the market above it and below that, because that means that you're going to be hard to go. So sometimes when the market's trading above a number, say this is 3,000, the market's trading up in here, and you're not bullish, you're sort of bearish, and say, okay, if I don't get 3,000, I'm going to sell it when it comes back under. Or if I get 2,500 here, I'm going to take a chance that's going to go greater than 2,500. So you can use the volume to help you time your particular trade. Yes?
Why not do a little price discovery? Because today...
You can do price discovery getting out of trades.
Because as the day goes on, and you get closer to the close, a market that's going like this, and then here, and then here, invariably, people are going to want to take their profits at the end of the day, and at the top end, there's probably a little less volume at those highs.
Your question is very good. It says, why not do some price discovery? The idea is you can put resting orders in where the market's going to go into you, and you're coming to the end of the day where people want to get out of the trade. That's fine. You don't have to hold the trade to completion. You're going to be able to adjust that program. You can basically take a smaller parameter. You can do a new program to answer your question. You can do a new 99 like this. Okay, and this is your 99 level, and said, I don't want to see more than 200 at any price. Okay, that gets you out real fast. So you can speed up your time frame with this program. Yes?
So this is cumulative volume throughout the whole day, right?
Pardon?
Cumulative volume?
Yes.
Through the whole day.
Yeah, and you keep parsing it, breaking it down, and if you break it down in the 99 3 different times, you want to go back to the original thing, you just hit clear, and you're back to where Cunningham front end is, and you start the whole process again. Or you could do it 5 times in a row, and you just keep squeezing the market into new orders. So it's a.
So when you say clear, that essentially clears all these numbers and starting at zero again.
Yes. No. What I'm saying is, when you hit clear, if you've done 5 99 programs, and you want to start over, you hit clear, and the market will revert back to the original to Cunningham at that point in time. So whatever's in Cunningham's display, okay. When you hit clear, it will come into your display, and then you start your process again. I know I'm not answering your question, so.
Yeah, I don't completely understand.
Okay, what I'm saying is that when you run a program and you get a 99 like this, so let's say this is one 99 program and it's over, and I run another 99 program, it's here, and I do another 99 program here. Now I'm confused as to the market because we have a range like this, and I want to go back. I want to go back to Cunningham, so I go back to the actual volume at these prices. And this is all canceled, right? And then I do 99 again, which is, so now I do a 99 again off of this, and I start over again.
So that the number may be different than the first.
It's going to be different. Yeah, because what we do is, in the formula we do, we just add the addition, and we want to keep a successive 99, and what it does is keeps tightening down the market to the new orders. So you can really squeeze it down. And here what you're going back and saying, I'm looking at the broad picture. So the time frames, which are very important, what this process is about, Dave's question was a time frame question. Your question is a time frame question. So he can use whatever volume size he wants to speed up the market. You can use whatever one you want to slow it down. So I can wait for the first 40,000 number in the S&P to make a trade. And as the market gets above or below it by a few ticks, make my trade and say, okay, it's not going to come back through it. So there's all different ways of approaching it. You know, what I'm saying is that you want to trade where the volume is to reduce the price discovery risk. You want to trade the new volume coming in because that's what gives you the direction, self-sufficiency.
So those are almost all like opening, like.
Yeah, absolutely, new days. Absolutely, that's what we're getting. No, there's no question about that. So we're coming back down to, you know, what we're looking at here in terms of the original part of the class, which we said we're trying to do. Okay, in other words, we want to trade as close as possible to volume. We want to understand the direction is self-generating. We want to trade new orders. Those are the three things that we're trying to do in relationship to the new exchange, which is the electronic exchange, which is going to remain here, right? We're not going back to the floor. We can do things on the floor where we have, create liquidity by doing leverage things, which we can do. And there's going to be a good, I think, opportunity for providing different services to smooth out supply. But we aren't going back to where we were before. So we take the volume thing on the first thing I showed you, that little red volume thing. If everybody basically followed this methodology, this is what people don't understand about the markets. They say the markets will self-destruct when you figure them out. So if we all basically followed my program, this volume would be in the middle instead of extremes. We just go back to a price-time market, wouldn't we? And how much capital time would that take as we get bigger and bigger traders off the floor and hedge funds and stuff like that? You know, so I think your question is very good. We don't care how big they are, how frequently they trade, because they leave tracks that we're following. It's pretty simple. So the basic thing you're going to do, that fundamental, reduce the risk of price discovery related to your trade before you make the trade. Then your success. We are having difficulty, I'm having difficulty at times because I'm making that discovery all by myself. I can't, if I do that consistently, I won't win.
Pete?
Yes?
What if they trade, you know, rather than being at a certain price, a large quantity, but it's within like 2 or 3, you know?
Yeah, I mean, it's going to be a range. It'll be a range.
Sitting in a small pocket of price.
Yeah, well, that's one of the reasons why I did the 99 like this, and then I basically put the strip 4 ticks below it and above it. So that would basically give me a high and low to put that into perspective. So if the market trades, all of a sudden we have 25,000 S&Ps trading at the same price I had the 99, that's going to explode. So these are relative positions that you will understand by experience. I mean, you can't write out all the, you know, if I was asking a good floor trader how to trade, you know, he couldn't begin to put it in an encyclopedia because all these little if, ands, buts, or whatever. So this is the nice thing about it. You're going to get feedback of what you're doing. Ask yourself, did I basically overpay for price discovery? Did I trade at a good enough volume area? You know, was I trading new orders? Okay. So when you answer these questions, you are critiquing yourself like we did on the floor. What did I do right? What did I do wrong? Versus saying, well, I just took a loss. Well, you want to learn from every loss that you have. And that's one of the advantages of being on the floor was we learned from every loss we took. And there's knowledge comes from losses, not gains. So the idea is in this environment, yes, question?
Have you found your principles of volume trading work better in certain markets over other markets?
No, they're the same in everything because that's the way the market is. The markets all today are supply price markets. So supply first and trade second, okay? And the idea is that before we get supply, there are people taking chances on price discovery that may be right, okay? But that's going to be a very hard, consistent thing to do. Because most of the trading, most of us make money because we survive how bad we are. We're not really good. I mean, my method of trading was if I did 10% right of all the things I knew at the right time, I could still make money. Okay, I wasn't trying to be 50%. I was trying to be as bad as I could be and make money and try to get that lower. So if I could make money at 8% efficiency, because by default, I'm going to be better than that, right? But by default, I'm not going to be better than 50%. So if you are a 70% effective individual and you're 50-50 in the market, you're 35%. We're 15% against what we have. Okay, we have to bring that back up by reducing risk related to the discovery of the price that we're looking at. And before, when we had the marketplace, we had fair prices on the board at all time because the exchange members were delivering it to you. Now you make a trade because you and I decide to make a trade. There's no consensus to either side. And in the old days, on the thing, we had the consensus is a fair price. Not necessarily that it was going to remain that way, but at least you had a fair entry. So right now, what's difficult about trading, you can have an unfair entry and an unfair exit. That really hurts your bottom line. Versus when we trade in the pit, we could have a fair entry and an unfair exit. Only one hammer. Any other questions? Well, if not, I enjoyed this very, very much, and we're going to be doing a live session probably in our office, which is 3805. For you to drop in for a couple, 5-10 minutes and move on. So it isn't like a hands-on thing, so you begin to see it. And then if you're interested in getting the program, talk to Steve, come to our office, and we should have this up on a website by Monday. And so then it's a PayPal deal. You just put your thing in and you get it. Okay. So we have a lot to do in terms of servicing that. But I do think that the future's in trading, and the future has always been best in your own hands. In financial field, when you pass off to somebody else to do the job for you, it never works. So, this is an opportunity for you to grow yourself and grow the industry and grow the exchange. And so I'm very, very excited about this. This is probably the biggest thing. I mean, X funds were really the biggest thing I've done because they were so good. And another thing was that, I mean, they made, out of 26 funds we had, they made 500% on margin. So just think of how we're doing today. The exchange is making $20 or $5 a contract. Public made $23,000 if they bought the funds, and there were 11 days and out. We could have had a guy like Richard Dennis play. This is a cannonball one. He's going to take it to the moon. We're not going to stop at 5,000. He's going to go in for 50. We could have very conservative guys. We would have the locals making market. The edge into the market was like $85 to $150. So the local could make money arbitraging. He could sell the X fund. If the beans were a strong one, buy 3 beans and sell 1 corn instead of doing the whole thing. It was really the perfect trade, and much better than ETFs. ETFs sold for $5 billion, and X funds was given up by the exchange, which is a sad, sad thing. But and the trouble was the scope of the project was too big for them to understand. Not that they don't work hard, they're trying to do the right thing, make the right decision, but that was a big failure in terms of what it's doing. That's the best thing I've done. This will be the next best thing I've done. Okay, any other questions? Yes.
What's the website?
About
Cunningham, you said?
It's going to be Cunningham LLC. I mean, I think check with Steve in our office. We'll get it down to Shadkin. I hate to be as unprepared as I am, but I don't know. We'll check here with Kurt. We'll get it. We'll get it to you.
Name on a piece of paper with email address, and we'll contact them.
Yeah, I think. Or we're up at 3805, so we'll get it out there in terms of doing it. So we have to get that part done. And we're working on it, and this is like so. Anyway, I think if you read this document, it should become pretty clear in the simple context. And again, what the best part of this program is putting orders in ahead of time for volume numbers. So as the market's breaking, I'm going to buy this number, or selling, I'm going to sell this number. That's really, you could have like 10, 15 things going at the same time. So, and basically, if you understand that market, you understand what the volume is in that market, normal or abnormal, then you're going to be landing in safe areas without looking at them. So right now, we're looking at beans. I want to buy those. I look at corn. I don't want to buy them. I look at the S&P. I want to buy or sell them. And manually doing this. So you can set this thing out to do everything. But starting out, you want to take one commodity and handle it. Okay, you don't want to do 5 or 6. You just want to take one, start with it, learn about it, then move to the second one. Anything else you want to do, Kurt?
No.
Okay.
Thank you.
Thank you.